Hello, I'm Maili Wong, Senior Portfolio Manager with the Wong Group at Wellington Altus Private Wealth, and welcome to our June summer update. As we head into summer, markets have delivered something we haven't seen in a while: stability, some gains, and a breath of calm air. After a few months of volatility and headline-driven swings, this quieter stretch seems like a welcome pause. Now let's chat about interest rates. In the U.S., the Federal Reserve has held interest rates steady again this month. Fed Chair Jerome Powell pointed to the continued strength in global domestic product and employment, two signs the economy is still humming along. But the Fed is also watching closely to see how the recently proposed tariffs will play out. The message? Let's wait and see what the final tariff package looks like and what kind of ripple effect it might have. It's like he's saying the economy continues to be strong and unemployment remains very low at 4.2%, so let's just wait and see. Closer to home, the Bank of Canada also paused. While Canada's economy has its own dynamics, our central bank is often influenced by U.S. policy, especially when it comes to tariff uncertainty and Federal Reserve conditions. The Bank of Canada sets interest rates independently, based on what's best for the Canadian economy. With that said, it closely watches the U.S. Fed, since U.S. decisions can impact Canada through trade, currency, and investment flows. So while the Bank of Canada doesn't always follow the Fed, it certainly can't ignore it. On the equity side, stocks have been mostly climbing. It's not flashy, but it's encouraging. Markets are showing that they can move higher even when the outlook isn't crystal clear. That's the nature of investing. Progress often happens in the background, not just in the headlines. And yes, uncertainty is still with us. But that's not new. It's why we build diversified portfolios. Holding a mix of sectors like energy, for example, can help smooth the ride when geopolitical flares take place. Recent tensions in the Middle East, particularly between Israel and Iran and now the US, have added to this global uncertainty. While the situation remains fluid, it's a reminder that global events can shift quickly, and that having exposure to different sectors and regions can help manage that risk. And while we're on the topic of geopolitical risk, it's worth remembering that markets have seen a lot over the decades, and they've kept moving forward. Historically, geopolitical events have not led to substantial declines in long-term returns for broad equity markets like the S&P 500. That's not to say that these events don't affect markets. They absolutely do, especially in the short term. But most geopolitical shocks haven't derailed long-term performance. Now, there are exceptions, of course. The oil embargo of the 1970s, for example, had a deep and lasting impact on both the economy and markets due to prolonged high oil prices. But that was the exception, not the norm. And more recently, when Russia invaded Ukraine in 2022, and the global energy markets were jolted, the world responded quickly. Additional oil supply came online, and the economic and market impact, while real, was far less severe and sustained than what we saw in the 1970s. It's also important to note that while global markets tend to recover, local markets can be hit much harder. So that's another reason why geographic diversification matters. By spreading the investments across regions, we reduce the risk of being overly exposed to one country or event. And over the past several months, we have been diversifying more internationally as well. This chart shows how typically fleeting the impact of geopolitical events are on equity returns. The dark blue bars show the average S&P 500 U.S. equity index returns, and the light blue bars show the average returns after major geopolitical events like wars, bombings, and invasions. Aside from the short-term negative impact over the first 3 months, the 6-month and 1-year returns are essentially the same. When you get right down to it, it's economic growth and corporate profits that tend to drive the market higher. And we're still seeing signs of that. Now let's talk about another chart that we love to show, the one that reminds us of how often markets correct. You've probably seen a version of this chart before. Maybe I've shown it a few times already, but I keep bringing it up because it's true. Corrections in the market are normal. They are not a sign that something's broken. They're just part of the journey. Think of it as a pit stop along a long summer road trip. They're expected, and they don't mean that you're off course. April's tariff tantrum this year was a great example of how large drawdowns can happen, and recoveries can be just as swift. So as we move into the second half of the year, remember, stay invested, stay diversified, and stay focused on the long term. This is what helps portfolios grow, and try not to get distracted by the news and media, even when the road gets a little bumpy. Thank you for tuning in, and we look forward to seeing you again soon.